That no landing economic scenario that everyone was talking about earlier this year, yeah, that's gone. The soft landing is fading fast too. Yesterday's big GDP number is running into the reality of another deluge of corporate warnings, and some of the biggest names around too. Nestle, Unilever. The auto industry is facing considerable setbacks, and those are spreading. It used to be you couldn't find a new car. Now there are so many on dealers' lots that manufacturers and dealers are beginning to slash prices. Commodity markets that once seemed poised to confirm the no landing, they've completely turned around and now many of them are crashing. Crude oil, gasoline, silver, aluminum, steel. The one thing you don't see or hear is more inflation. Bond markets didn't flinch on yesterday's GDP because the goods recession was all over the details of the report. And it's all over the stock market too, as Bloomberg reported just yesterday. Almost a third of S&P 500 companies have reported second quarter results so far, and the spotlight is increasingly on the sales figures where the slowdown is starting to become more visible. Is it just a slowdown? Only 43% of companies have managed to beat revenue expectations, which would be the lowest reading in 5 years, at least according to data compiled by Bloomberg Intelligence. And that's exactly what the GDP numbers showed yesterday, especially in nominal terms, the goods recession. And what markets are pricing is that the goods recession isn't done yet, not by a long shot. The good news in all of this is that there is no more inflation or consumer price pressures. The bad news in all of this is why that is. And why that is something that Nestle can tell us all about. The stock was hammered yesterday as it reported weaker earnings, weaker results, weaker forecasts especially. Nestle said it expects sales growth of at least 3% for 2024, marking a downgrade from its previous projection of around 4%. It comes as the Swiss company is trying to win back customers after high prices due to inflation has resulted in customers opting for cheaper brands, exactly what Walmart had told us. And the company's results over the last year have been driven almost entirely by price expansion. This is not unique to Nestle nor food companies. Many businesses around the world had become almost dependent upon price increases and managed their business accordingly, including hiring too many workers, expecting that price increases, or the good times as they saw it, were going to continue to last. But as we saw in GDP, around the end of last year, as unemployment began to rise all over the world, the slowdown became a little bit more than a slowdown. As Nestle CEO Mark Schneider commented, we've seen pricing come down faster than expected. Therefore, we consider it prudent to adjust our guidance for the year, with organic sales growth now expected to be just 3%. As I said, the stock was down big as the marketplace really did not like what Nestle had to say. Although on macroeconomic terms, it seems positive that lower prices and companies are unable to pass along these price increases to their customers. The reason why that is their customers have no money, their customers are increasingly worried about employment. That's not good for Nestle or the rest of the economy. One company that did seem to learn its lesson, or learn some of these lessons, was Unilever. Though Unilever reported disappointing results too, especially where it comes to sales and revenue, they did understand that if they stop raising prices as fast as they had, they'll get more customers back. So unlike Nestle, Unilever's stock was up on margin expansion. They're better able to manage their costs in this slowdown goods recession environment. The price growth in the latest quarter, which is the second quarter of this year, was reported to be just 1%. 1% price growth in the latest quarter versus 8.2% in the same quarter of 2023. Massive slowdown in price changes. And Unilever's CEO Heinz Schumacher was on CNBC, and he said, "We've seen good volume growth." Well, that's what he calls good volume growth. It literally wasn't. A sequential improvement in all of that. But pricing was a bit subdued. And that was also the result of the commodity basket that saw a much lower inflation than obviously we've seen over the past couple years. And when we see that, we're focused on competitiveness as well. And if we can give it back to the consumer, then that's what we do. And it's a nice sentiment, but that's not actually true. These businesses would continue to raise prices if they could get away with it. And that's what inflation is supposed to be. That's what the mainstream definition of inflation is, right? We're taught it's about a tight labor market or oil prices or some kind of cost pressures that businesses must absorb. They compete for workers, higher wages, and then therefore they have to pass them along to their customers. But time and time again over the last little while, we've seen companies continue to say we can't pass our price increases along to customers because our customers can't afford it. And by the way, it's starting to eat into our not just price changes, but also revenues overall. Businesses are suffering on the top line. And their best hope now is to manage their bottom line, which Unilever did that Nestle didn't. So the stock price on Unilever was rewarded, even though the macroeconomic implications of both were exactly the same. And this is exactly why Eurodollar University offers memberships and subscriptions, so that you can not only stay on top of what's happening, but just as important, understand what it all means. Because let's face it, while there's lots of useful information out there, economics leaves us with no way to make sense of it. Most of what you hear about the state of the economy, what interest rates are doing or what interest rates might do, what money even is, what you get is just pure nonsense. So we have memberships and subscriptions, and our anniversary sale is in its final 2 days. This weekend will be the end of our anniversary sale. So if you're interested at some of the best prices we've ever offered at Eurodollar University for memberships and subscriptions, check us out at our website, eurodollar.university. In addition to Nestle and Unilever, there are others. Let's talk about the auto industry. A big player in the auto industry, or big supplier in the auto industry, microchips. STMicro reported earnings this week that were truly grim. First half revenues decreased 21.9%. Again, this is revenues year over year, mainly driven by a decrease in microcontrollers and power and discrete segments. The operating margin was 13.8%, net income was $865 million. But they continued. During the quarter, contrary to our prior expectations, customer orders for industrial did not improve and automotive demand declined. And company CEO Jean-Marc Cherry told analysts on his conference call, "We are facing a longer and more pronounced correction in industrial than we anticipated due to a progressive weakening of demand amplified by a severe inventory contraction." And they're trying to blame this on EV sales, but as I said at the top, we're seeing the automotive industry as a whole become really pressured by weakness in consumer demand. Wholesale demand too, but mainly consumer demand. In fact, Ford's CFO, a guy by the name of John Lawler, said just a couple weeks ago, "It worries me that stocks are building." By stocks, he means inventories of autos. "We haven't seen that impact so far, but we are watching it very closely." He said that also that Ford is targeting 50 to 60 day supply on dealer lots, but it had, in the month of April, 100 days supply, which was well above the national average of 76, at least according to Cox Automotive. So even in the auto industry, where it wasn't that all that long ago, you could barely find a vehicle on any dealer lot, now they're starting to pile up as flagging sales meet rising production, and maybe those two have finally crossed. Now, Lawler was relatively sanguine about Ford's ability to navigate that challenge and think that maybe there's just a little bit of a production trim might better align inventories and sales. But overall, we're seeing price pressures emerge that we haven't seen since before the pandemic, all of which point to ongoing and worsening goods recession. According to J.D. Power just recently, by the end of this month, retail inventory is projected to be around 1.6 million units. Now, that's a decline from recent months, but still 32.5% above last year. And the reason why it's an increase or a decrease in inventory in July versus June is because this is the model year turnover. So the 2025 models are coming on, the 2024 models are being sold down. And it's not like that inventories are declining because there's faster sales, even though there was more sales pushed forward into this month due to the computer problems at the end of last month. More and more, the dealers are running into problems selling their stock, and it's starting to pile up. Continue with J.D. Power. The average new vehicle retail transaction price is declining compared with a year ago due to higher manufacturing incentives, larger retailer discounts, and rising availability of lower priced vehicles. Transaction prices are trending downwards, 44,271, which is down over $1,000 or 2.6% from last July. In total retailer profit per unit, which includes vehicle gross plus finance and insurance income, that's expected to be $2,298, which is down a third from July of last year. Rising inventory is the primary factor behind the profit decline, and fewer vehicles are selling above the manufacturer's suggested retail price. And this is something that we see in a whole bunch of data points outside of the automotive industry, or what the automotive industry prepares on its own. We've seen it in retail sales from the Census Bureau. Nominal retail sales on autos have been flat to lower, and especially lower in the month of June. Some of that, again, was about the computer snafu that really impacted quite a lot of dealers in the United States. But even so, auto sales overall in nominal terms look a lot like the goods recession in total. Even the US CPI has shown declining new vehicle prices. For 6 straight months, the entire first half of 2024 so far, new car prices have been falling with some pretty substantial declines, especially in April and May. And for the CPI, new auto prices have been falling 8 of the last 9 months. Some real softening going on here in the auto industry. It starts with the goods recession and it filters its way from there. Dealers now have too much stock because sales are weakening. And with dealers having too much stock, manufacturers are starting to cut back on orders. As manufacturers cut back on orders, that affects component suppliers like STMicro, and on it goes, as STMicro now needs fewer of its own materials, fewer workers, and on as the goods recession spreads out into other parts of the global economy. With that in mind, that's why we're seeing weakness in commodities. A lot of commodities looked relatively strong, looked like they were pricing some kind of reflationary trend earlier in the year and maybe in the middle part of the year with some like copper and aluminum. But over the last several months, as this good recession becomes more visible in terms of corporate warnings as well as data produced by outside sources, as the goods recession becomes more and more visible, commodities are reflecting the goods recession, not reflation. And in many ways, it wasn't really about reflation to begin with. A lot of it was supply. That was certainly the case with copper, aluminum, as well as crude oil. Crude oil this week is set for its 3rd straight weekly decline. As of Friday, it was under $77 per barrel, which was its lowest price since early June. Most of this decline in oil is being blamed, at least initially, on China, overseas. China, bad economy, US, strong economy. Did you not see GDP? And the Chinese are at least playing up to their part, because this week we saw surprise rate cuts from the PBOC on Sunday, which was Monday morning Chinese time. They cut their 7-day repo rate. The banking system followed closely thereafter with cuts to the loan prime rate. These were both surprises. Nobody expected them. The PBOC then reduced its MLF by 20 basis points, so another rate cut during the week. And as one analyst said, the semi-panicky moves are increasing concerns that Chinese energy demand may be further into the future than expected. And that's always the case with Chinese energy demand as well as its recovery overall. Every year the Chinese say we're going to recover. Every year Western analysts and Western economists say we expect China to recover. And every year China disappoints. And we're seeing that again this year. We see it in specifically energy markets as the country reports lower imports of crude oil. That's depressing global demand, as is the United States. It's not just a case of China weak, US strong. Everyone has been saying something similar about the U.S. economy too, especially where it comes to demand for summer driving. How much have we heard that over the last couple of months? Summer driving is going to be a blockbuster this year. The U.S. economy is strong and resilient. Labor market tremendously strong and resilient. But instead, summer gasoline demand, meanwhile, is not lifting gasoline prices. Market analysts have been forecasting a tighter 3rd quarter, with U.S. crude inventories declining 3 weeks in a row. But gasoline demand was soft for the week ended July 12th, declining by 615,000 barrels per day. It actually came back the week after, but still the point remains. Daniel Galley, who's a senior commodity strategist at TD Securities, said demand expectations continue to plummet, which is weighing on the broad commodities complex, which is exactly what we're seeing here. This time around, he said, supply risks are not providing an offset to the deterioration in demand sentiment. It's not just China, it's also the United States. Forget the second quarter GDP. Listen to what Nestle, Unilever, STMicro, and the commodity space is telling you. Weaker energy prices, falling copper, falling aluminum, silver had a bad week as well. All of these key commodities, steel prices in China, just absolutely plummeting to what was a new 7-year low. So it's not China weak economy, U.S. strong economy. It's China really weak economy, U.S. economy following in the same direction. So overall, the markets ignored GDP, treasury yields falling, tips break-evens falling, bull steepening still ongoing, because companies are telling you whatever was in GDP, the goods recession was there too, and they're reinforcing that message in their own results and earnings, especially forecasts. We had Nestle, we had Unilever, STMicro. Those are on top of a number of those that we've gone over, from Target to McDonald's and everything in between. Where it comes to consumers around the world, not just in the US, they have no money. They also have to deal with prospects for rising unemployment on top of everything. So consumers right now can't afford to spend in the way they want, which is why they all say we're in a recession. At the same time, they're facing all of these pressures on their own fiscal budgets. They also have to consider a weakening labor market, not just in the US, but around the rest of the world. The goods economy, the goods recession, is already producing the negative impacts on employment, and it is spreading there too. And policymakers know it. They understand that as the unemployment rate rises, as unemployment itself rises, and the chances of unemployment rising are going up as more and more companies complain about their top-line sales problems, the risk to the overall economy is that it spreads way beyond the goods part of it, because unemployment will eventually lead consumers to really cut back even more than they are, which leads businesses to do even more cutting back in terms of hours and employment than they're already doing themselves. And it just becomes the vicious cycle, not of goods economy recession, but broader economy recession. What really stood out in the second quarter GDP numbers was that goods economy recession. And that's what I talked about in the video linked below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. Check out our anniversary sale, final couple days here. And until next time, take care.